Welcome to the Deep Dive. Today we are wading into the financials of a massive specialty retailer. And this one is a real head-scratcher.
It really is.
We have a definitive beat and raise quarter on the numbers,
Yeah.
but the market absolutely hammered the stock. I mean, it dropped nearly 7% right after the release.
It's the ultimate contradiction, right? And our mission today is to figure out why. We're going to dissect the operational brilliance that led to the Q3 financial success, because there was some genuine high-quality execution there.
For sure.
And then we need to zero in on the management commentary about the Q4 holiday outlook, because the market clearly heard two completely different stories, and we need to understand where all that pessimism is coming from.
Okay, so let's unpack this. We'll start with the cold, hard numbers for the 13 weeks that ended November 1st. And the financial performance was, well, it was stellar.
No other way to put it.
The headline number that just jumped off the page was adjusted earnings per share. They reported 63 cents per diluted share.
Which is astronomical when you compare it to the street consensus. I mean, analysts had braced themselves for what, 16 cents?
16 cents.
Yeah.
So they delivered a 294% surprise. That's not just exceeding expectations, that is fundamentally rewriting the narrative for the quarter.
Absolutely. And this wasn't just some kind of financial engineering.
No, the top line was strong too.
Right.
Revenue came in ahead of expectations at $1.392 billion. That's a solid 3.1% jump year over year.
But for a retailer, the real test is always same-store sales, SSS.
And that's where you see the positive inflection. Same-store sales were up 3.0% year over year, a huge reversal from the year before, which was down almost a full percent.
And if you drill down into that, their three biggest brands, Kay, Zales, and Jared, they delivered a combined SSS of a very, very strong 6%.
So you have a massive EPS beat, higher revenue, positive sales momentum, and they even raised their full-year guidance. On paper, it looks like a slam dunk.
It does. And yet, the stock tanks almost 7%. On huge trading volume. So for you, the listener, this is the central puzzle. The market looked at a quarter of clear operational momentum and decided to price in failure.
Which means we need to look past those top-line numbers.
Yeah.
Let's dig into the Q3 wins, because this wasn't luck. This was high-quality margin management.
It really was. Gross margin expanded by 130 basis points to 37.3%.
And how did they pull that off with inflation and everything else going on?
Well, there are two main drivers. First, their actual merchandise margin expanded by 80 basis points, so that shows pricing discipline.
Okay.
But second, and this is the really important bit for stability, their high-margin services business saw high single-digit growth in comps.
So things like repairs, warranties.
Exactly. And that segment is incredibly sticky. It's now delivered nearly 5 consecutive years of positive comps. It's like a recurring high-profit anchor in the business.
That gives them a nice buffer. But let's talk about the merchandise itself. Management said average unit retail, or AUR, was up 7%. That means people are spending more per item. They're trading up.
They absolutely are. And this leads us right to the huge strategic shift in their product mix. They have dramatically accelerated their adoption of lab-grown diamonds. We'll just call them LGDs.
Right.
LGDs allow them to offer, superior size and value at certain price points, and that's what's driving that higher AUR.
So how significant is this LGD shift? It sounds like more than just a trend.
Oh, it's fundamental. LGDs are now approximately 40% of their bridal sales.
40%.
Wow, think about that. That's up from the mid-30s just 6 months ago. And in fashion jewelry, LGD penetration has roughly doubled year over year. It's about 15% of fashion sales now. This pivot is central to their margin story.
Wait, hold on. If they're selling LGDs, which are generally lower cost than natural diamonds, how are they also getting a 7% increase in the average price? Wouldn't that pull prices down over time?
That is the critical question, and the answer is mix management. They're using the higher perceived value of LGDs, getting a bigger stone for the same price, to get customers to trade up into the next price bracket.
Oh.
So they're essentially replacing a smaller natural diamond purchase with a larger, higher ticket LGD purchase. The cost structure is different, but it protects that overall margin.
That makes a lot of sense. Okay, let's talk about a huge challenge that could have completely derailed this quarter.
Yeah.
The India tariffs.
This was a serious, immediate threat.
Management was facing a situation where tariffs on certain imports from India jumped from 5% to over 50%. That's a massive spike.
A huge portion of their supply chain was suddenly exposed to that. A lot of their specialty cuts, stone polishing, it all comes through there.
So how do they manage a beat and margin expansion while absorbing that?
This is where the phenomenal execution comes in. Management confirmed they successfully mitigated a majority of that impact. Through rapid sourcing adjustments, relocating some production, they even moved some of it to the US, and just driving efficiencies everywhere. It allowed them, in their words, to take the downside off the table for the whole year. It's a huge strategic win.
And you see that agility in the capital discipline, too.
Yeah.
Inventory actually ended the quarter down 1% year over year.
Which is incredible when you think about it. They were dealing with rising gold costs and the tariff nightmare, and they still kept a tight leash on inventory.
It really signals operational tightness.
Absolutely. And beyond that, their cash flow improved by over $100 million for the quarter, and they're returning that capital. They bought back $28 million in shares in Q3 alone,
Bringing the year-to-date total to...
nearly $180 million. That's over 6% of their outstanding shares returned to shareholders. Management is really walking the walk.
Okay, before we get to the gloomy stuff, let's quickly touch on their branding. They launched this Jared Story Diamond Collection. Why is the new collection relevant here?
Because it links their ESG efforts, blockchain traceability, repurposed metals, renewable energy, directly back to that high AUR narrative we were just talking about.
So they're positioning sustainability as a luxury feature.
Exactly. They're trying to build a moat to say, we can charge a premium because we offer full traceability and sustainability, which helps them protect that 7% AUR increase. It's margin protection dressed up as luxury marketing.
Okay, so Q3 was a masterclass in margin protection and supply chain agility. Yet, the stock is down 7%. It's time to confront the cold shower, the Q4 guidance.
Precisely. This is where the core of the market's sell-off resides. Because while the full-year outlook was technically raised, the Q4 forecast embedded a, frankly, jarring level of caution.
The Q4 same-store sales guidance, I mean, the range is just dramatically wide. They're projecting anywhere from a decline of 5% to a small gain of 0.5%.
And that negative 5% downside is what the market latched onto. It instantly overshadowed everything good about Q3.
Management was also pretty specific about the risks, weren't they?
Very specific. They cited external disruptions since late October, saw weaker traffic over the past 5 weeks, and flagged decreasing consumer confidence. They even said it was hitting brands exposed to lower and middle income customers the hardest.
So that tells you the luxury buyer driving that AUR increase is probably still fine, but the mainstream consumer is hitting the brakes. And that slowdown started right after the quarter ended.
It creates this bifurcated outlook. The market just interpreted that wide range as management admitting they have no visibility into the holidays and that a severe downturn is a real possibility.
This street hates uncertainty.
Hates it, but they did highlight a very specific strategy to counter what happened last year. If you remember, last year's shortfall wasn't really a traffic problem.
Right, it was a conversion problem. They had people in the stores, they just couldn't sell them anything.
Exactly. They were under-inventoried in those key gifting price points. Stuff under $1,000 and especially under $500. A customer would walk in for a gift, they just didn't have the right item at that mass market price.
So they walked out. How are they fixing that this year?
They adjusted directly. They said they have made a material investment in lab-grown diamond fashion jewelry, specifically for those lower price points.
So they're stocking the shelves with what people actually wanted last year.
That's the plan. Their whole Q4 strategy is built on the belief that the 10 days leading up to Christmas, which they say are far more important than Black Friday, will see strong conversion because they finally have the right inventory.
What's so fascinating is the market psychology here. The stock drop reflects a wholesale focus on that macro fear, on that minus 5% SSS number. It completely ignores the operational fixes.
It does. It ignores the margin protection, the raised full-year EPS, everything. The market is pricing in the risk that unit volume declines are just going to be too steep to offset, even with the higher prices.
So the fear is that the AUR increases can't save the day if unit velocity just falls off a cliff.
Exactly. And you can see that conviction in the trading data. The stock finished down almost 7% on huge volume, and there were flags about unusually large options volume. People were actively betting on the downside.
So even while management is still doing smart things like refreshing stores and planning to close underperforming locations,
all those long-term positives are just getting ignored in favor of the immediate Q4 consumer outlook.
which brings us to our next segment. We have a disciplined, operationally brilliant quarter contradicted by a very nervous outlook. So let's think aggressively about this market divergence.
And let's be very clear here. This is a thought experiment only. We must stress this is not financial advice.
Not financial advice.
We are simply taking the market's extreme pessimism, that 7% sell-off, and matching it against management's very specific operational solution to last year's holiday failure.
The bet here centers entirely on whether they actually fixed that conversion problem. The stock drop suggests the market thinks they haven't. That -5% SSS is the base case.
But the thesis is based on their material investment in that LGD fashion jewelry at the sub-$1,000 price points. They have the inventory they wish they had last year. And they believe the 10 days before Christmas are what matters.
So the play is to bet that the market is over-discounting that worst-case outcome.
Right. If that Q3 execution carries through and that heavy investment in cheaper LGDs actually drives conversion in those final 10 days, if SSS hits the higher end of the range, say flat to positive 0.5%.
The stock should see a sharp, violent reversal off this low.
You could theoretically buy far out of the money call options expiring in early 2026. Your downside is just the premium you pay, but the upside has substantial convexity if they pull it off. It's a pure, high-leverage bet on their merchandising team overcoming the macro headwinds in the 2 weeks that matter most.
A very sharp insight into how someone might play this volatility. So what's the final takeaway for you as you process all this?
For me, it's a quarter that was defined by disciplined execution and significant margin protection, despite massive headwinds. But that caution around the Q4 consumer just proved to be the single dominant narrative for the street.
Which leaves you with a really interesting final thought.
Yeah.
Given that this company's merchandising discipline allows them to offset high gold costs and tariffs through, supply chain nimbleness and mixed strategy, should investors view jewelry retail less as a traditional cyclical sector tied only to consumer confidence?
And more as a data-driven, logistics-focused operator whose real differentiator is now supply chain agility.
We invite you to consider that shift. The future of retail might not be about desire, but about distribution.